Something is happening in Beijing right now that represents the most significant shift in this crisis since it began. Not because of what you are seeing in the headlines. Actually, the headlines are covering this exactly backward. Over the last 72 hours, the People's Republic of China has issued quiet but unmistakable instructions to its state-linked shipping conglomerates, COSCO Shipping Energy Transportation, China Merchants Energy Shipping, and the tanker subsidiaries operating under ICBC Financial Leasing, to recall a substantial portion of its very large crude carrier fleet from the waters west of the Strait of Hormuz. Vessels that were scheduled to lift Iranian light, Iranian heavy, and discounted Russian ESPO blend cargoes have been redirected. Some have been ordered to hold position east of the Gulf of Oman. Others have been instructed to complete their current voyages and return to Chinese ports at Ningbo, Qingdao, and Dalian without accepting follow-on charters. The Western financial press is treating this as a commercial story, a freight rate story, a story about world-scale points and charter party negotiations. That framing is not just incomplete. It is wrong in a way that obscures the single most important strategic signal coming out of East Asia this year. Because when the world's largest crude oil importer, a country that consumed over 11 million barrels per day of imported petroleum last quarter, begins pulling its merchant tanker fleet out of a specific maritime theater in a coordinated fashion, that is not a commercial decision. That is strategic pre-positioning. And the only question that matters is what Beijing's strategic planners at the Central Military Commission and the National Energy Administration are seeing in their intelligence picture that the rest of the world is not yet pricing in. The answer to that question reveals why the global energy calculus, the entire architecture of assumptions that has governed oil markets, naval deployments, and great power competition since the 1973 embargo, has just fundamentally broken. To understand what Beijing is actually doing, you have to understand what a tanker recall means at the operational level. A VLCC carries approximately 2 million barrels of crude oil. The Chinese state-linked fleet comprises somewhere between 120 and 140 of these vessels when you include the shadow fleet tonnage controlled through Hong Kong-registered shell entities and Greek-flagged intermediaries operating on long-term time charter to Sinopec and PetroChina trading arms. Pulling even 20 of these ships out of the Persian Gulf loading rotation removes roughly 40 million barrels of carrying capacity from the most critical choke point in the global energy system. The Strait of Hormuz handles approximately 21 million barrels per day of seaborne crude and condensate, representing nearly a third of all maritime oil trade on Earth. When China, the single largest customer for crude transiting that strait, starts telling its captains not to enter, the message being sent is not to the shipbrokers in London or the charterers in Singapore. The message is being sent to Tehran, to Riyadh, to Abu Dhabi, and most importantly, to the Pentagon's J2 Intelligence Directorate and the headquarters of United States Central Command in Tampa. The message is, we believe the waterway is about to become kinetic, and we are not going to have $400 million worth of our hulls sitting at anchor off Kharg Island when it does. But there is a second thing almost no one is connecting properly. This tanker movement is happening simultaneously with a sharp, unannounced acceleration in China's strategic petroleum reserve intake. Satellite-derived inventory estimates from commercial analytics firms tracking tank top levels at Zhoushan, Zhanjiang, and the newer underground cavern complexes in Gansu province indicate that Chinese commercial and strategic storage has added approximately 40 to 50 million barrels of fill in roughly 30 days. That is a pace not seen since the spring of 2020, when Beijing exploited negative oil prices to engorge its reserves during the pandemic demand collapse. Except this time, prices are not collapsing. Brent crude is holding above $85, which means Beijing is willing to pay premium prices to accelerate its stockpile. A state does not pay premium prices to fill strategic reserves unless its planners have concluded that future prices will be significantly higher, or that future physical availability will be significantly constrained, or both. This reveals something fundamental about the limits of the market's current pricing mechanism. The oil futures curve is still in a mild contango for distant months. The market is telling you supply will be adequate. Beijing is telling its own logistics arms that supply will not be adequate. One of these two readings of the future is going to be proven catastrophically wrong within the next 90 days, and every piece of circumstantial evidence suggests the market is the one that is mispriced. The first thing you need to understand to make sense of this entire picture is the doctrinal shift inside the Chinese national security apparatus regarding what Beijing internally calls the Malacca dilemma, and what has now quietly expanded into what strategic planners at the PLA Academy of Military Sciences refer to as the dual choke point vulnerability. For 2 decades, Chinese energy security doctrine was obsessed with the Strait of Malacca, the narrow waterway between the Malay Peninsula and the Indonesian island of Sumatra, through which approximately 80% of Chinese crude imports transit on their final leg to East Asian ports. The entire strategic rationale behind the Belt and Road Initiative, the Gwadar port development in Pakistan, the Kyaukphyu pipeline through Myanmar, and the military buildup in the South China Sea can be traced to this single fixation. But the doctrine has evolved. Beijing's planners now recognize that Malacca is actually the secondary vulnerability. The primary vulnerability is the loading end of the voyage, not the transit leg. If the Strait of Hormuz is closed, whether by Iranian naval mining operations using the improved Shahid Bahonar-class fast attack craft, by direct strikes on Ras Tanura and Ras Laffan loading terminals, or by a wider regional conflagration, drawing in Houthi anti-ship ballistic missile fires from western Yemen against tankers transiting the Bab el-Mandeb, then it does not matter how secure the Malacca transit is, because there will be no cargoes loaded at the origin to transit. The recall of the fleet tells you that Beijing's threat assessment has elevated the probability of a Hormuz disruption event to a level where the expected loss of maintaining presence exceeds the expected revenue of continued operations. That is a mathematical threshold that only gets crossed when intelligence indicates something is coming. And what is coming is not a single event. It is the convergence of three distinct escalation ladders that are now braiding together in a way that the previous decade of regional analysis did not prepare the market for. The first ladder is the continuing Israeli campaign against the Iranian nuclear program infrastructure, specifically the hardened enrichment facilities at Fordo and the conversion and weaponization adjacent sites that Israeli intelligence, in coordination with specific elements of the American intelligence community, assesses have progressed beyond the threshold at which conventional airstrikes alone can reliably neutralize them. The second ladder is the quiet but measurable Iranian redeployment of Islamic Revolutionary Guard Corps Navy assets, including the Ghadir-class midget submarines and the newer Fateh-class coastal submarine, into patrol patterns that indicate a shift from deterrent posture to pre-strike posture within the Persian Gulf. The third ladder is the disintegration of the tacit understanding that had previously kept Houthi anti-ship operations geographically bounded to the Red Sea approaches. Recent targeting patterns of the Noor and Ghadir series anti-ship cruise missiles, combined with what appear to be Iranian-supplied Shahed 136 loitering munitions repurposed for maritime strike roles, suggest that the Houthis are now capable of, and have been authorized to, extend their strike envelope northward into the Gulf of Oman. When you put these three ladders together, you get a picture in which every single one of the major maritime oil arteries feeding Chinese refineries is simultaneously at elevated risk. Beijing's tanker recall is the perfectly rational response to that picture. The fact that Western capitals have not issued comparable guidance to their own flag tonnage is not evidence that the risk is lower than Beijing assesses. It is evidence that Western capitals are making a different political calculation about what they can say publicly without moving markets and triggering the very crisis they are trying to deter. The second thing the market is missing is the interaction between the Chinese tanker recall and the Russian crude export mechanism. For the past 2 years, the sanctions architecture imposed by the G7 price cap coalition has relied on a specific fiction that Russian Urals and ESPO crude could be tracked, that the shipping insurance provided through the international group of P&I clubs could be used as a choke point to enforce the $60 price cap, and that the so-called shadow fleet of aging tankers operating outside of Western insurance regimes could only absorb a limited portion of Russian export volumes before physical and financial constraints became binding. That fiction is now collapsing, and the Chinese tanker recall is the accelerant. Because the vessels being pulled back from the Persian Gulf are in many cases the exact same hulls that have been alternating between Iranian loadings at Karg Island and Russian loadings at Kozmino on the Pacific coast and Novorossiysk on the Black Sea. When Beijing pulls this tonnage back to Chinese ports, it is simultaneously removing it from the Iranian export chain and from the Russian export chain. Moscow's Urals discount is about to widen sharply because the marginal buyer of last resort has just pulled its trucks out of the parking lot. Indian refiners, Reliance Industries at Jamnagar and the Nayara Energy Complex at Vadanar, will not be able to absorb the diverted volumes at the pace required because Indian port infrastructure and refinery turnaround schedules do not permit that kind of surge ingestion. The result is going to be a physical oversupply of Russian crude searching for tankage at exactly the same moment that a physical undersupply of Gulf crude creates a bidding war for what little non-Russian barrels remain available. The price dispersion between Brent and Urals is about to become violent, and the secondary effects on European refinery margins, on German and Italian diesel crack spreads, and on global jet fuel availability heading into the winter travel season are going to be severe in ways that no published forecast from the major investment banks has yet incorporated. This reveals something fundamental about the limits of the sanctions strategy as it was designed in 2022. The entire price cap mechanism was built on the assumption that Chinese and Indian demand for discounted Russian barrels was effectively infinite at the margin, that there would always be a buyer willing to take the cargo at some price below the cap, which meant Russian revenue could be squeezed without actually removing barrels from the market. That assumption is now being falsified in real time. Chinese demand is not infinite. It is a function of Chinese domestic refinery runs, Chinese strategic storage capacity, and most critically, Chinese tanker availability to move the barrels. When Beijing recalls the tankers, it removes the physical transport layer that made the whole sanctions evasion economy function. Russian barrels stranded at loading ports are not a problem for Moscow alone. They are a problem for the global balance because stranded barrels do not reach refineries, and refineries that cannot run crude cannot produce the diesel, gasoline, and jet fuel that the global economy consumes every single day. The tanker recall is therefore not just a pre-positioning move for a Gulf War scenario. It is also, simultaneously, a de facto tightening of the sanctions regime against Russia, imposed not by Washington or Brussels, but by Beijing's own internal calculus about where it wants its fleet to be when the shooting starts. The third thing, and this is the piece that ties the entire analysis together, is what the recall tells us about Beijing's read of the American naval posture in the region. The United States currently has the Dwight D. Eisenhower Carrier Strike Group elements rotating with the Abraham Lincoln Strike Group in the broader CENTCOM area of responsibility, with the R. Lee Burke-class guided missile destroyers of Destroyer Squadron 22 providing the primary surface combatant screen. The Amphibious Ready Group, built around the Wasp-class amphibious assault ship and its embarked Marine Expeditionary Unit, has been operating in the Gulf of Aden with extended patrol patterns. The Ticonderoga-class cruiser, providing Aegis ballistic missile defense coverage, has been vectored toward positions optimized for intercepting Iranian Shahab-3 and Khaybar-Shikan medium-range ballistic missiles on ascent trajectories toward Israeli airspace, which means those hulls are not optimally positioned for anti-ship missile defense of merchant traffic transiting the strait. Beijing's planners see this posture. They understand that the American fleet, as currently deployed, is optimized for strike support and ballistic missile defense of Israeli territory, not for convoy protection of oil tankers, which means that if the Iranians do initiate a maritime closure event, whether through explicit mining or through asymmetric harassment operations using the IRGCN swarmcraft doctrine, the response timeline for restoring safe transit is measured not in hours, but in weeks. Weeks during which any Chinese tanker sitting inside the Gulf would be a hostage, not to Iranian forces, but to the entire dynamic of a closure event from which there would be no quick extraction. Pulling the fleet out now, before the event, is the only way to ensure that Chinese tonnage does not become a bargaining chip in someone else's escalation. And this is where the global energy calculus breaks. For 50 years, the unwritten rule of the international oil system has been that the United States Navy provides the public good of freedom of navigation in the critical choke points, and everyone else, allies, partners, competitors, even adversaries, free rides on that security guarantee because it is cheaper to do so than to build parallel capabilities. That bargain was the foundation of the petrodollar system, of the architecture of OPEC Western cooperation, and of the assumption baked into every long-term oil contract signed since the 1970s that crude purchased from a Gulf producer will actually be delivered to the buyer. Beijing is now signaling, through the simplest and most unambiguous action available to a state, the physical movement of its own ships, that it no longer believes the guarantee is reliable, that it is willing to pay the opportunity cost of idle tonnage and foregone cargoes in order to secure its own fleet rather than trust the American security umbrella. And once that signal is sent, it cannot be unsent. Every other major importing nation, Japan, South Korea, India, Turkey, will now have to make their own calculation about whether to follow Beijing's lead, because if the Chinese assessment is right and the others do not follow, they will be the ones holding the bag when the closure event occurs. And if the Chinese assessment is wrong, the mere fact of the recall still imposes costs on the old system by demonstrating that the largest player in the market no longer trusts its architecture. Either way, the system has changed. Either way, the old calculus is gone. The market has not yet priced any of this in. Brent crude is trading in a range that implies perhaps a 15 to 20% probability of a major Gulf disruption event within the next quarter. The options market, measured through the skew on out-of-the-money call options on the ICE Brent contract for the front 3 months, is pricing tail risk at historically modest levels given the underlying geopolitical picture. The insurance market, measured through the war risk additional premiums being quoted by Lloyd's syndicates for tankers transiting the Hormuz Joint War Committee listed area, has widened but not to crisis levels. Every one of these indicators is lagging the Chinese signal by a factor of weeks, possibly months. The window for repricing is closing. When the repricing occurs, and it will occur because physical reality always wins against financial fiction given enough time, the move will not be gradual. It will be violent because the positioning in the futures market is long biased on the refined products side and short biased on the volatility side, and unwinding those positions in a compressed time frame is the mathematical recipe for a price spike of the kind last seen in the summer of 2008 and in the first 2 weeks of March 2022. Your watch window over the next 48 to 72 hours is concrete and specific. Watch for additional COSCO shipping energy and China merchants. Energy shipping AIS transponder signatures indicating further vessel redirections out of the North Arabian Sea and the Persian Gulf. These signals are publicly visible on commercial maritime tracking platforms and will confirm whether the recall is broadening or stabilizing. Watch for Chinese commercial crude imports from Saudi Arabia, the UAE, and Kuwait to show a measurable drop-off in the reported customs data for this loading month. which would confirm that the recall is translating into actual cargo flow reductions rather than just tonnage repositioning. Watch for any movement by the Indian Ministry of Petroleum and Natural Gas to issue comparable guidance to Indian Oil Corporation, Bharat Petroleum, and Hindustan Petroleum regarding their chartered tonnage in the same waters. Because if New Delhi follows Beijing's lead, the closure assessment becomes a consensus view across Asia, and the market repricing becomes unavoidable. Watch for the United States Navy to issue updated maritime security transit corridor advisories or to reinforce Task Force 153 operating in the Red Sea with additional surface combatants. Any such reinforcement confirms that Washington's intelligence picture is converging with Beijing's, even if the public rhetoric remains calibrated to avoid market panic. And watch for the Iranian Foreign Ministry and the Supreme National Security Council to issue statements regarding freedom of navigation. The specific linguistic framing used in those statements, whether it invokes the 1982 Law of the Sea Convention or the more aggressive framing of Iranian sovereign waters interpretations, will tell you whether Tehran is signaling restraint or signaling a legal predicate for closure. The tankers are already moving. The storage is already filling. The ladders are already climbing. The balance of power that governed the flow of oil for half a century has not shifted. It has fundamentally broken.